What if I told you that there's a company out there revolutionizing covered call ETFs and it's producing annual dividends between 12 to 14% while protecting your principal? You may think I'm a little crazy, but in this video, we're gonna be talking about one of those companies, and that specific company is NEOS. Now, NEOS has created some of their two big flagship ETFs, as in SPYI and QQQI. Now, SPYI has been around for about 3 years, while QQQI has been around for about a year and a half. Now, they don't have the biggest track records, but NEOS in itself, the creators of this company, are the ones that are revolutionizing covered call ETFs, and they didn't just start 3 years ago. They've been doing this for about 25 years. So, let's grab that coffee, let's get started, and let's talk about some of these NEOS ETFs and see how they can be added to your portfolio, or maybe you should throw them away. Hey guys, my name is Steve, and I run the Frugal Expat website where we try to help people to save more and invest better. Today, we are talking about NEOS ETFs, as in QQQI and SPYI. Now, right before we jump into this video, let's just talk about NEOS itself. Now, NEOS is a company called Next Evolution Options Strategies, created by Troy Cates and Garrett Palelo. Well, I probably just butchered his name. Now, these guys didn't just jump out of the wagon and started creating some revolutionized funds. They've been doing this for 25 years, and they came together to create a fund company, NEOS, to help investors like you and me to create some premium income, be tax efficient, not have capped upside, and have monthly income that we can sustain and live on. So, we're going to be talking about some of their best funds, which is QQQI and SPYI. Now, we're going to be talking about the NEOS strategy. Now, the NEOS strategy is something a little bit unique. Most covered call ETFs, what they do is they sell covered calls on their underlying assets, and that's the end of the day. Now, at that point, they have some capped upside. And what that means is if the market rallies hard, well, you're not going to see kind of that rally within your ETF. Your performance is going to be capped because your strategy is to create premium income on the assets. What they do, instead of capping you on the upside, they will take the income from the premium income sold on the covered calls, and they will reinvest it into out of the money covered call buy options. So when the market does rally, they get a piece of that upside. And we have seen this recently. In April of 2025, QQQ dropped. I mean, the Nasdaq-100 was down 18, almost 20%, and it was in bear market territory. Same for QQQI. But since then, both QQQ is up 9%, 10%, 11%, while QQQI is up 9 and 10%. Now, that is amazing news. If you were thinking about JPQ on the other hand is still down further than QQQ. Now it's doing about 2 to 3% in total return, while QQQ is up 9, 10%. Now QQQI, like I said, is up 9%. So those are some good numbers to think about. Now that is amazing news, because if you are looking for a ETF that gives you upside income, well, NEOS creates those ETFs for you. Now, another thing NEOS does is they use 1256 contracts. And so what they're doing is they're going to have in distributions, it's going to be more like 60% long-term capital gains and 40% short-term capital gains. So what's going to happen is these are going to be more tax efficient. Then they're going to also do some tax loss harvesting and return a lot of the money into distributions as a return of capital. Now your cost basis will go down, but what's going to happen is you're not going to be taxed on that return of capital, because it's like me giving a fund manager $100, they give me back 10 of that $100, and now my cost basis is $90, but I'm not getting taxed on the money they gave me back. So once all that cost basis gets down to zero, well, everything's going to be returned to you as a long-term capital gains, and that's just going to depend upon where you are on your taxes for long-term capital gains. And so that's making it a lot more tax efficient than, let's say, JPQ, which is everything is taxed at an ordinary income level, and that could be kind of a tax nightmare. So that's something to think about. They're doing tax loss harvesting. It's more tax efficient. You can put these in taxable accounts, and they're getting the upside and giving you a premium. Well, to me, it's already sold me. Well, let's keep going and let's talk more about these ETFs. Now, Now, the first ETF we're going to talk about is QQQI. Now, QQQI is the cover called premium income ETF on the Nasdaq-100 that NEOS runs. Now, it's got an expense ratio of 0.68%, which means it costs about $68 for each $10,000 invested. Now, right now, it's got a trailing 12-month distribution yield of about 13.86%, but according to their website, they're distributing at about 14.65%. Now, it's got about $3.07 billion assets under management, and that is a heck of a lot of assets under management in a year and a half process that it's been around since January of 2024. So think about that. I mean, a year and a half, and it's gained so much momentum. Right now, year to date, it's down about 9%. Now, the monthly distribution level right now is sitting at about 62 cents per share, and that's averaged anywhere between 58 cents per share all the way to 64 cents per share. So that's good news to you. You're thinking about how much I'm going to get per share. It's about 62 cents per share, maybe a little bit less, maybe a little bit more. Depends on the month. It depends upon the volatility. Now, this ETF, like I said, tracks the Nasdaq-100, so it's going to have companies like Microsoft, Nvidia, Apple, Google. It's going to have Amazon, Tesla. These are some of the great companies that are part of this ETF. Now, the good news about this ETF is it's getting 14% dividends, so monthly. So you're getting paid every single month and you're getting dividends. Secondly, the upside isn't really capped, so it's kind of trailing, it's kind of on par with QQQ since inception. That's great news to you. Thirdly, it's going to be more tax efficient, so that's good news to you. And lastly, it's got one of the best sectors in the market. If you're looking to have some of that growth and tech into your portfolio, well, QQQI could be that ETF for you. So now, some bad sides is there could be some massive drawdowns that could happen. The tech market could go flat and it could wipe out some of those gains, and that could be some bad sides. They got a high expense ratio of 0.68%, and you could possibly get something cheaper. And the fact that volatility is sitting at a 1.98%, and that could be some bad news to you if you think about that. And the fact that this ETF's only been around for a year and a half, so we don't have as much data as we do on many other ETFs. So that's about QQQI. Now let's dive into SPYI. Now, SPYI is a little bit different. It tracks the S&P 500, so it's got a little bit more diversification. It's been around for 3 years. It's been around since August of 2022, so you have a little bit more data. Now, the dividend yield is about 12%. It's got an expense ratio of 0.68%, the same as QQQI, and it's got about $4.45 billion of assets under management, so it's a lot bigger than QQQI, but QQQI is coming up and strong. The monthly distribution is about 51 cents per share, so it's a little bit less than QQQI, but still, you got a lot more diversification. You have a lot more companies, and it's a little bit more stable and less volatile than QQQI. Now, some good things about this: it's doing about 7% year to date, so that's great news to you. It's been around for 3 years. It's been pretty stable, and in the last 2 years, it's increased its dividend year upon year. So that's good news to you guys. For this ETF, those people that are looking for a more conservative approach compared to QQQI, it could be a good place to be. For those that are looking for more of a stable ETF on the S&P 500, this could be a good ETF for you. Those that are looking for less volatility, this could be a good ETF for you. Like I said, it's about 51 cents per share, so that's pretty good income. If you think about it, if you have 100 shares, that's about $51 per month. If you have 1,000 shares, that's $500 per month, and so that could be something that you may be looking into. Now, obviously, these two ETFs are very different. One is tracking the S&P 500, one is tracking the Nasdaq-100. One has a little bit more upside because it's a little bit more volatile, as in QQQI. It's got about a 9% year-to-date return, while SPYI has about a 7% year-to-date return. Now, QQQI has a higher dividend yield of about 14%, while SPYI has a dividend yield of about 12%. Now, SPYI has been around for 3 years, while QQQI has been around for a year and a half. So SPYI is a little bit more stable, and it's been around longer, and we have more data. So that could be something that you'd be looking into more conservatively. If you take SPYI, that could give you a more broad-based diversification compared to QQQI. If you're looking for more upside, QQQI does a little bit more upside. Now, NEOS in general is a great company, and it's been around a lot longer than most people thought. Now, this company may have started a little bit rough because people didn't trust it because it was brand new and on the market, and and you know, people just don't trust things that are brand new. Like when you get your car, you're like, oh, this brand new car may have some kinks and stuff, but once you get to about 2 or 3 years and you're like, oh, this is quite reliable. That is something that NEOS is building. It's building trust. It's got great strategies. It's got some good income strategies. It's not capped upside, and it's got some good tax efficiency for people that are looking for that. So should you be investing into NEOS? Well, if you want to take a more conservative approach, you could start a little bit at a time. You can start with 5%, maybe build up to 10% and see how this income ETFs are working. Now, there are definitely some risk, and that could be, I mean, if you're investing in the market anyway, you're going to have a little bit of risk. QQQI is a little bit more risky because it's got a little bit volatility due to the Nasdaq-100. Now, SPYI is a little bit more conservative. They both have some great yields. They both have some return of capitals, so that's got to be something to think about. They do have some cover called ETF strategies that you may not want, or you may want, and you may just want someone else to actively manage those ETFs, and that's why NEOS is a great company, because they actively manage these ETFs. Now, those are some things to consider. Now, should I invest in these? Well, as I'm looking at these look like some great places that I can invest in if I want some premium income. If I wanted some more upside, I would just invest in QQQ or SPYI. But right now, we are looking at these as income producing assets instead of those that have some more upside. So, are these great for income? If I was close to retirement, I would definitely consider this. I mean, my dad is always looking at some great dividend paying companies, and he's trying to create a portfolio that will pay him some dividends. So if there were maybe an active managed ETF that could help him out, well, this would be something I would suggest to him. Will he take my advice? Who knows? Will you take my advice? I don't know, but let me know in the comments. Do you invest in NEOS ETFs? Do you like SPYI, or do you like QQQI? Personally, I like the tech, so I like QQQI. If I wanted more diversification, I would go with SPYI. Those are my thoughts. Let me know in the comments. Do you like these ETFs? Let me know. And you should check out my last video on, is QQQI the best cover call ETF? Right up here. I'll see you guys in the next video.